Are we in the middle of a housing bubble? Ah, that was actually a lot louder than I thought it was going to be. What's up, everybody? It's Jeff Bonk here from the HBB Group and eXp Realty here in Hoboken. And there is so much talk lately about housing bubble, housing bubble, housing bubble, housing bubble. And first and foremost, disclaimer, I don't know if we're in a housing bubble or not. And anyone who tells you differently, I think you should look at a little longer and take a second thought about what you're taking from them, because nobody has a crystal ball. But what we do have is facts. What we do have are trends. And we have things that can at least give us a good idea of what's happening historically and where we are economically, and what we can, best guesses we can make and make decisions off of those pieces of information, rather than a lot of headlines and a lot of just hyperbole, which is the thing that's been bothering me a lot, what I've been seeing out there, which really made me want to make this video. There's headlines that say this market's crashing, or this market's crashing, or that's going to happen, or we're too much of that. And then you read the actual article and there's no supportive evidence, and there's not even a supportive argument there. It's just assumptions and things that may happen. So first of all, if anyone tells you they know what's going to happen, take a second look at that person and make sure you're understanding the facts of what's really happening, what's happened historically, that kind of can show us maybe some ideas of where we are, give us the best education to figure out what we should be doing. And if you hang on to the end, I'll talk about what I always say when it comes to timing the market. And we'll wrap up with that in a second. So first and foremost, I'm going to pull some slides. We're going to pull some stats, a couple of infographs here that'll give us an idea of where we are in the world right now when it comes to real estate, when it comes to the economy, when it comes to all the different things that we should be thinking about and considering. First of all, this was done just a week or two ago, and the survey was worries about a housing bubble. And they were asking both clients and agents, are you worried about a housing bubble? And 77% of consumers are right now currently concerned about a housing bubble, which to me blew my mind, because we see 5 offers on every single property still as of this week, right? With interest rates up, everything you're hearing in the news about potential bubbles and things like that, 77% people concerned, but there's still 5 offers. So something's not matching the data versus the headlines here. And the really crazy thing here is 44% of agents are concerned about a housing bubble persisting right now in this market, which again, I think, it's education. It comes down to the facts. And what are you looking at that tells you that? Is it just headlines? Is it just what goes up must come down? Like, what is the science behind those thoughts and things that are driving these feelings? So this is something we need to talk about. It's something we need to have a conversation around, because of this right here is just not matching what the market is showing us. First thing I want to talk about is a reason we should be concerned, right? It's not all roses. It's not all just, let's just make an argument for why we're not in a housing bubble. The first thing I want to talk about is maybe something we should keep our eye on that could be causing some reason for softness in the future. Housing affordability. And when you look at affordability, it's really how much money of the money you make has to go towards your house, right? If you make $100,000 and $10,000 needs to go to your rent or your mortgage, that's pretty affordable. If you make $100,000 and $50,000 needs to go to the house that you want to live in, that's not so affordable, right? Just how much room is left for other things. And there's a lot of different metrics that go into this with inflation and cost of interest rates and things like that. But the chart here, we're looking back 30 years, right? It's crazy that 1990 is 30 years ago. And we're looking at affordability. And right now, it's not as affordable as it's been in the early 90s, 2000 phase. When you see the orange there, that's when there was right after 2008 crash, which we're going to talk a little bit about in a few minutes here. But right now our affordability is, kind of on that line of where it really makes sense for a healthy market. So as prices continue to go up, we need to keep an eye on incomes. We need to keep an eye on the job market. We need to keep an eye on the things that are going to tell us how much money these buyers are making and how much real income they have to spend on their housing. So this happened in 2018. Prices went up. Incomes didn't go up as quickly. And we saw softening for about 6 months until things leveled out. And then when they made sense again, buyers picked right back up and we saw more appreciation, which is what we're still seeing today. So it's real. It's something to keep our eye on. Is it catastrophic? Is it a bubble? Is it a crash? Probably not. It's probably something that will cause maybe some slowing, a little bit of maybe flattening, maybe a little decline, but I don't really see how affordability creates a crash. So that's the first thing we're looking at here. The second thing is recession. I keep hearing words about recession. We're raising interest rates because we need to combat inflation, but usually rising interest rates can also lead to some recessions. A lot of different reasons. The cost of money is becoming more expensive. Businesses can't do as much as they want to do. They can't hire and grow and expand. It causes some contraction, which is essentially what a recession is. But what does that mean for real estate? What I found really interesting when I dug into this a little bit, 3 out of the last 5 recessions, real estate actually appreciated during them. 1 in 1991 only depreciated by 2%, and one in 2008, which was caused by bad housing practices, by bad lending practices. Again, we'll talk about it in a few minutes, depreciated greatly. So we have this memory of recession equals big drop in real estate prices. But when you look back 30, 40 years here, the worst years that we had for our economy, we still saw appreciation in housing, except for one other year where it was almost marginal at 2%. So just something perspective, right? I hear, well, housing's going to, the economy is going to go into recession. I'm going to wait. Well, why? If most years that there were recessions, prices actually appreciate. It's not actually correlated. It feels like it is by what the news is saying, by things that I read in the headlines. It feels like that would make sense. But we look at the data, it's not quite there. It's actually the opposite story. The third thing we need to look at is inventory, another buzzword out there. No inventory, no inventory, no inventory. Inventory drives, supply and demand drives the health of a market. If there are a ton of buyers in the marketplace and there's no homes for them to buy, I'm not sure how that creates a bubble, right? All of a sudden, there's going to be tons of homes and no buyers. The supply and demand charts is not going to move that quickly. One estimation I heard earlier this week was that we're at a 7 million home deficit for the amount of homes we need in this country. Baby boomers aren't moving as much as we thought they were going to move. Millennials are now coming into the real estate world with big force, and they need homes. We haven't built them fast enough because all the builders were scarred by 2008 when they got caught holding the bag, and they got caught overbuilding in a very inflated market caused by some very bad lending practices and irresponsibility. And now they didn't build as much in the last 10 years. So we have a deficit. We also have old and decaying houses. People don't want to live in them, or they can't live in them anymore, right? So we have this deficit that's just mismatched. We have no inventory. This is only going back to 2019, right? And this market's been hot the entire time in here. The market's been hot. It's been very strong appreciation the whole time. And right now, we saw an uptick last month, yes, from like 1.6 to 1.7. But look where we are historically over what a strong market was over the last few years, right? Just another thing, if there's no inventory and there's 5 offers on every property, bubbles are a hard thing to really make a strong case for. And then we have inflation. Everyone's worried about inflation, right? Rates are going up because of inflation. To combat inflation, groceries are through the roof, gas prices, everything is inflated. We have record CPI, record inflation numbers. Look at over the last 50 years what real estate has done against inflation decade by decade. It has beat inflation decade by decade, every single one except for 2000s, which was, it missed by 0.3%. So if you're worried about inflation, real estate seems to be a good hedge. Another good number that, something that scares people. I'm worried about inflation, it can crash the market. Well, real estate's almost always outpaced inflation throughout the years. So just another piece of data that makes the story in the headline not really actually accurate. And now let's talk about 2008, right? Everyone's worried this is a bubble, the run up. The last time we felt this type of appreciation, all we saw was, just crazy price after price after price going up and up and up. And then we saw a pop and we saw a crash. Well, there's 2 reasons why this isn't like last time. There are probably 50 reasons, but the 2 biggest ones that I think that are important, one is the lending practices, and 2 is the equity in homes. So I don't have a chart for the equity in homes, but the average home buyer has something like 40 or 50% equity in their home today. Due to appreciation and putting large down payments on their properties, we don't have this upside down world where people are putting no money down, then refining out another 10% and just continuing to pull equity out of homes. That's not allowed today, and it's not done today. And people don't want to do it today because they know what happened 10 years ago, 12 years ago when it was so irresponsible. So much equity in homes that if prices drop a little bit, people don't need to panic and sell them. The banks aren't going to be taking them away because there's equity, there's options. You could sell that home. Even if you lose your job and the prices drop a little bit, you have now 30% equity. You can go sell that home and go live someplace else without having to go into bankruptcy, short sale it, letting the bank take your property. So that's the one thing. There's enough equity to absorb any type of small flattening or decline that wouldn't cause a pop of a bubble. The second is lending practices. If you look at the orange lines here, this is leading up to 2008, and it's the amount of loans that were made in the marketplace with the credit was under 620. Now, what's good and bad credit? We can all draw lines different places, but I think sub 620, everyone would agree, is probably not ideal credit report to look at their last 5, 10, 15 years of financial responsibility. There was 350,000 loans per year being made sub 620 credit for 2008 when things crashed. Irresponsible lending. Today, we're looking at 25, 30, 40,000 loans that are made sub 620. Now, those loans are probably have way more equity in them. They're being well more scrubbed for actually income. Are they making money? What caused that? When they go through underwriting now, they're looking for a story that supports why this credit is low. And then they're making an approval rather than just anyone with any credit score got a rubber stamp. Yes, you get a loan, no money down. And that's what caused 2008 to be such a catastrophic event, one of many reasons, but one of the bigger reasons in my opinion. So where does that leave us? I mean, there's a case for that the affordability could definitely cause some cooling and slowing. It's one piece of data, but there's also a lot of data, supply and demand, what happens during recessions, what kind of lending practices we're looking at today, that you can make a strong case that this could continue to appreciate and be a healthy market for another year, 2 years into the future. The last slide I'll lead you with, and the last thing that I'll talk about is the home price forecast for 2022. And this was done about a month ago. It's by all the major guys, your Fannie Mae, Freddie Mac, your NAR, Zillow, all the top people in the space. And it's anywhere from 3% on the low end to 9.6% on the high end, averaging out to, you see the green line of about 6.7% is what the major economists that have studied this space are expecting to see in the marketplace over the next, now only 8 months. I can't believe it's April already, almost over. So this is where we're at today, guys. And the one thing that I want to say to wrap up all these ideas, right? And I always talk about this when people say, I want to time the market. Is this a good time? Is this a bad time? What should I be doing? You can't time the market, but you can time your specific situation. And if you're in a place where you're going to be in a home for a year or two, you might get a job transfer, you might need more space, you might need to take that money and do something else with it, you probably shouldn't buy right now. You should probably rent. It's not great timing for you. Be more flexible. Don't take on the overhead. Don't take on the more expensive transfer costs to buy and sell, title search, all the fees, everything like that. And just rent, pay the broker fee and move on and have the flexibility. If you are going to plan to be in that house for 4 or 5 years, maybe own it for 6 years, 7 years, renting it out for a few years, and you have a longer time horizon, history will show us that it's a better decision to purchase a property. The appreciation, tax write-offs, the just overall paying down of the loan all add up to being a smarter financial decision to own that property and have all those things working in your favor rather than paying someone else's mortgage off for a long term. Time your situation. Don't try to time the market. If you're an investor, if you're a flipper, if you're some different conversation, we're talking about primary residences here. We're talking about where you want to choose to build wealth and build some equity in for the future for your family. And if that's what you're looking to do, make sure the timing works for you. Make sure you're looking at things, you're informed, but then make decisions based from that place, not headlines, not someone who thinks they know all the answers. Take a look at the data. So guys, I hope this was helpful. If you have any questions, if you want to talk about your specific situation, the HBB Group is standing by. One of our awesome agents will be happy to engage with you, go through line by line what makes the most sense for you in the market you're looking in and your current situation, and be able to really provide some clarity there and a plan forward. So guys, have a great day. We'll see you soon.